This is Matthew Kratter's Bitcoin University. Today I want to talk about the dangers of MSTX and MSTU. These are levered ETFs on MicroStrategy, and this is part of a MicroStrategy series that I've been doing, so you can check out my previous 4 videos on MicroStrategy. This is how the volatility ladder looks. We have Bitcoin saying, please help me, it's so volatile that it hurts. Anyone who's invested in Bitcoin can be quite painful until you get used to it. Then the next level, we have MicroStrategy. Yo dog, I heard you like volatility, so we added some volatility to your volatility so that you can eat volatility for breakfast, lunch, and dinner. And then we have the levered MicroStrategy products, these levered ETFs. They're basically saying, hold my beer. MSTX, a daily target 2x long MicroStrategy ETF, and MSTU is a similar product offering 2x daily returns. Now, Wall Street loves levered ETFs because they can charge very high fees. And I think these levered ETFs are also interesting because they show us that the SEC doesn't give a shit about unsophisticated retail investors. These are really not the kind of products that you want floating out there, especially when most people don't understand how they work. To look at the expense ratios for these, the spot Bitcoin ETF from BlackRock, IBIT, they charge an expense ratio of 0.12%, going up to 0.25% after 12 months. By contrast, these levered ETFs always have much, much higher fees or expense ratios. MSTU charges 1.05% annual expense ratio, and MSTX charges a 1.29% expense ratio. So that's why Wall Street likes these products. Why do retail investors like these products? Well, they like them because they can give you leverage when something is going up, and they can increase your returns in one direction. So these levered long ETFs, whether Bitcoin or otherwise, or MicroStrategy or otherwise, levered long ETFs perform best when the underlying instrument is going straight up day after day after day without any pauses. Now, obviously, if you're levered long and the underlying instrument goes down, you're going to lose big because you're betting 2x that it's going to go up and it goes down. So big moves up and big moves down makes sense in terms of what you expect. But I think there's something that a lot of traders and investors in these products do not understand, and that is this very important fact that any sort of sideways chop destroys a levered ETF. This is called volatility drag. You'll sometimes see it called decay risk. And this occurs because of daily rebalancing in the levered ETF, as we're going to see. If you take a close look, as we said, these are called daily target ETFs because they're basically targeting these returns over one trading day. And this is where the tracking error can come in when you hold these over multiple trading days, as we're going to see. If you're finding this video helpful, I'll just pause really quickly here to ask you to help to support this channel's mission. Hit the subscribe button, leave a like, leave a comment, question, suggestion for a future video. Share this video with a friend or family member. That would really help. So in order to understand the various scenarios with these levered MicroStrategy ETFs, let's take a look at a generic ETF, which I'm just calling the underlying stock. I'm calling ABC, and then we have the levered ETF which offers 2x daily returns. So in the first scenario, this underlying stock, we're going to have it basically go up $20 a day for 3 days in a row. It's going to go to 120, then 144, and then 172.80. So basically going up 20% a day. And you can see the positive compounding that happens when you have returns in a row like this. You get the compounding effects. Now, if you package this as a 2x levered ETF based on the underlying stock ABC, and instead you offer a daily target ETF, you're going to basically have returns of 40% per day. So instead of going from 100 to 120, it's going to offer 2x that daily return. It's going to go from 100 to 140. So this is really where levered ETFs shine, where you have day after day of positive returns. And we can see if you were doing the unlevered version, if you just own the underlying stock, over these days, it went from 100 to approximately 173, while the levered product went from 100 to 274. So we can see how this works on the upside. Now, obviously on the downside, it compounds as well. So in this next scenario, we're going to have the underlying stock going down 10% a day for 3 days in a row. It goes from 100 down to 72.90. The levered ETF, the levered 2x long ETF, is going to be going down twice as much on a daily basis. And so the first day it's going to go down 20%, then 20%, then 20%. And so in this case, with a levered product, after just these 3 days, you end up losing almost 50% of your capital, whereas in the underlying, you've only lost 27% roughly. So obviously this makes sense. No one expects to make money if you're levered long something and the instrument goes down. Now let's take a look at what is a more common condition in markets, which is sideways chop. They're usually not going straight down or going straight up for any long period of time. So in this scenario, we're going to have the underlying stock just oscillate, just chop back and forth between 100 and 110. So the first day it's at 100, it closes at 110, then it drops back down to 100. The next day it goes up to 110, and the next day it goes down to 100. So these are all daily closes. So it's basically going up 10% and then down 9.09% because of how the denominator works there. So the so the levered 2x ETF is going to do twice these returns. Instead of going up 10%, it's going to go up 20%. So in that first day, you're looking really good because the stock goes from 100 to 110. The levered 2x daily target ETF goes from 100 to 120. But then when we get the situation of sideways movement or sideways chop with volatility, this is where you end up in trouble. And so on the second day, the stock falls from 110 down to 100. It's down 9.09%. Obviously, the levered ETF will double that return, and we can already see a problem starting here. The original stock falls back down to $100 per share where it started, but because of the compounding effects, the levered ETF has fallen down to 98. So even though if you had held the stock, you'd be break even, holding the levered ETF here, you're actually down almost 2%. And now the next day, the stock bounces back up to 110. That's a 10% return. And so the levered ETF goes up 20%. But you can see already here that there's another problem. It is now it has now failed to reach that previous high of 120. Now it's only at 117, 118. And then something bad happens again when the underlying stock falls from 110 down to 100. It's down a little bit more than 9%. The ETF goes down a little bit more than 18%. And we're now sitting at 96.4. So you've almost lost 4% of your capital, whereas if you were holding the underlying, you'd be back to even. So if there's sideways chop like this, your levered ETF will continue to decay. This is what's called decay risk or volatility drag, where the stock is just chopping around. You're not really making or losing any money, but the levered ETF is losing money. And this is the problem because, as we all know, most of the time the market is not trending, it's chopping around. And this is what makes levered ETFs lose money most of the time. Again, you're going to make a lot of money if the underlying stock goes straight up. You're going to lose a lot of money if the stock goes down. And so there's really only one situation where you make money, where the stock goes straight up. If it goes down or if it chops around sideways, in both of those cases, you lose money. And then there's also this tracking risk. This is from the MSTX prospectus, daily correlation tracking risk. There's no guarantee that the fund will achieve a high degree of leverage correlation to the underlying security, to MicroStrategy, and therefore achieve its daily leverage investment objective. To achieve a high degree of leverage correlation with the underlying security, the fund seeks to rebalance its portfolio daily to keep exposure consistent with its daily leveraged investment objective. The possibility of the fund being materially over or underexposed to the underlying security increases on days when the underlying security is volatile near the close of the trading day. And so there's this possibility that the fund will not be able to put on a sufficient position using swaps or using options, which is how these funds provide the leverage to the end user of the ETF. If they can't get their exposure by the end of the day, there's going to be even more tracking error. And if you understand how Bitcoin works and how MicroStrategy works, you know that the probability of the underlying security of MicroStrategy being volatile near the close of the trading day is actually very high. So you have this slippage tracking risk as well, where the ETF may not be able to get enough exposure to the underlying to provide those 2x daily returns. So in conclusion, levered ETFs like MSTX and MSTU, they're best used solely as intraday trading vehicles. If you hold them during the day, if you're doing some day trading, which I don't really recommend at this point, but if you're doing day trading, there can be pretty good vehicles. But if you hold them overnight or for multiple days or weeks or heaven forbid months, you will be exposed to this decay risk and this volatility drag, especially if the market turns sideways. So here's the problem with holding these as a proxy for MicroStrategy. MicroStrategy could go from $300, $400 a share to $5,000 a share over the next 12 months, and you can still get slaughtered holding a levered 2x long MicroStrategy ETF if MicroStrategy takes a volatile path getting to 5,000, which it most certainly will. If it goes straight up, you're going to do much better than the underlying security than either Bitcoin or MicroStrategy. But if it does it in a choppy, volatile manner, it's more likely that Wall Street's just going to make money on you and you're going to end up losing, even though you were right about your price target for MicroStrategy. If you enjoyed this video, be sure to hit the subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video, and let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.